Friends, thank you for being here today. We need to have a serious conversation. It is a conversation that the mainstream financial news networks are largely ignoring. And quite frankly, it is a conversation that requires us to look past the headlines and dig into the raw data. We live in an era of sound bites and rapid-fire news cycles, but when it comes to the preservation of your wealth and the stability of your retirement, we cannot afford to be superficial. We need to look at the facts, however uncomfortable they may be. Something profound happened recently. It was an event that should have stopped the presses, yet it was buried in a routine SEC filing released on a Friday afternoon. For those of you who have spent time in the corporate world or followed markets for decades, you know exactly what a Friday afternoon news dump means. It is the time selected by public relations departments and legal teams to release information that they are legally required to disclose, but that they desperately hope no one will actually read. It is a tactic designed to minimize impact and avoid scrutiny. But we are scrutinizing it. And I am curious, how many of you have noticed this pattern of bad news quietly dropping late on Fridays? It's an old corporate trick, but it still works. Let me know in the comments if you've spotted other examples of this recently. Goldman Sachs, arguably the most connected and powerful investment bank in the history of modern finance, quietly disclosed that they had reduced their United States Treasury bond holdings by hundreds of billions of dollars. This wasn't a minor adjustment. This wasn't a simple portfolio rebalancing to capture a quarter point of yield elsewhere. This was a calculated, systematic, and massive exit from what we have been told for our entire lives is the safest asset class in the world. Goldman Sachs looked at United States Treasury bonds, the bedrock of the global financial system, and said, "No thanks." They sold. And they sold massively. But the story gets darker. They are not alone. When we aggregate the data from the past 18 months, major financial institutions have collectively dumped over $847 billion in United States government bonds. That number is difficult to comprehend in the abstract, so let us contextualize it. $847 billion is more than the entire gross domestic product of Switzerland. It is 3 times the annual budget of the United States military. It is a sum of money so vast that it signals a fundamental shift in the plumbing of the global economy. The smartest financial minds in the room, the people with the deepest connections, the most sophisticated algorithms, and the most to lose, have decided that they do not want to own U.S. government debt right now. Meanwhile, the television pundits are telling you that inflation is under control, that the economy is achieving a soft landing, and that everything is returning to normal. We have to ask the obvious question. What do they see that the average investor does not? What do the people with access to proprietary data and private intelligence know that would make them run from the safest asset on earth? Before we move on, I want to ask you a question. When you see a disconnect like this between what the news says and what the big banks do, who do you trust? The pundits or the money trail? Let me know your thoughts below. Today, I'm going to walk you through exactly what is happening. We are going to put aside the hysteria and the noise, and we are going to look at the math. We are going to analyze the collapse they are preparing for, and by the end of this discussion, you will understand why that $847 billion figure isn't just a statistic, it is a fire alarm. To understand the gravity of Goldman Sachs' move, we must first revisit the mechanics of the fire. I know that for many, bond math can seem dry or academic, but right now it is the single most important concept for your financial survival. When you buy a U.S. Treasury bond, you're lending money to the federal government. In exchange, they promise to pay you back with interest over a set period, 10 years, 30 years, etc. The critical rule of bonds, the rule that governs everything we are seeing today, is this. Bond prices and interest rates move in opposite directions. This is a mathematical fact, not a theory. When interest rates go up, the price of existing bonds goes down. Let's apply this to the reality of the last few years. Imagine you were a prudent institution in 2020. You bought a 10-year Treasury bond paying 2% interest because that was the going rate. You paid $1,000 for that bond. It was considered a safe, conservative investment. Fast forward to the present day. The Federal Reserve, in an attempt to fight inflation, has raised interest rates dramatically. New 10-year bonds are now paying 4.5%. Now imagine you try to sell your old bond. You go to the market and say, I have this bond paying 2%. The market looks at you and says, why would I pay you $1,000 for a bond paying 2%? When I can go to the government and get a brand new one paying 4.5% for the same price? They wouldn't. The only way you can sell your 2% bond is to discount the price. You have to sell it for $800 or $700. You have to take a loss. For an individual holding a few bonds, this is annoying. For a bank holding billions of dollars in bonds, this is catastrophic. This dynamic is exactly what killed Silicon Valley Bank in March 2023. They held billions in safe. Treasuries bought when rates were low. When rates rose, the value of those bonds collapsed. When they were forced to sell those bonds to raise cash for depositors, they realized massive losses that wiped out their capital. The bank died in 48 hours. Now, zoom out. Silicon Valley Bank was a regional player. We are now talking about the titans of the industry. In their third quarter 2025 filing, Goldman Sachs disclosed that their U.S. government securities holdings had decreased by 42% compared to the prior year. This is a liquidation. They moved from approximately $280 billion down to roughly $160 billion. That is $120 billion gone in a matter of months. JP Morgan Chase reduced their securities portfolio by 15%. Bank of America sold off $37 billion. Regional banks dumped another $290 billion. The banks will issue press releases stating that this is about capital efficiency or regulatory compliance under Basel III rules. Those are the polite excuses they give to calm the public, but look at the action, not the words. By selling these bonds now, these banks are often taking a realized loss. They are accepting a hit to their bottom line today. Why would a bank, an institution designed to maximize profit, voluntarily take a loss? They only do that if they believe the future losses will be much, much worse. They are cutting off a gangrenous limb to save the body. They are exiting the bond market because they believe bond prices are going lower and yields are going higher. They are preparing for a world where U.S. government debt is toxic. This brings us to the specific strategy Goldman is employing, the fortress mentality. Goldman Sachs isn't just selling bonds. They are fundamentally restructuring their entire survival strategy. If we look closely at their earnings calls and their balance sheets, we see a distinct pattern emerging. It is a pattern of extreme defense. In addition to dumping treasuries, Goldman has increased their cash reserves by 38%. Cash is the ultimate defensive asset. It pays nothing in terms of growth, but it offers optionality. In a crisis, he who holds cash is king. They have reduced their exposure to commercial real estate by 29%. We all see the empty office buildings in our cities. Goldman sees the loans backing those buildings going to zero. They are getting out before the collapse. They have tightened credit standards. They are lending less. They are reducing leverage. In a booming, healthy economy, banks do the exact opposite. They lend aggressively. They minimize cash to chase yield. They buy assets. The fact that the most sophisticated bank on Wall Street is hoarding cash and selling assets tells us that they do not believe the soft landing narrative. They are battening down the hatches for a hurricane. Goldman Sachs has survived the dot-com crash, the 2008 financial crisis, the European debt crisis, and the COVID crash. They did not survive by being lucky. They survived by seeing the iceberg before the ship hit it. And right now, they're steering the ship away from U.S. Treasuries. However, there is a specific immediate catalyst that is forcing their hand: the commercial real estate time bomb. While the bond market is the systemic fire, commercial real estate, or CRE, is the gasoline that is about to be poured on it. I want to expand on this because it explains exactly why Goldman Sachs and others are rushing to raise cash right now. This is not a theoretical problem for 2030. This is a tangible brick-and-mortar crisis happening in 2026. Walk through the downtown district of almost any major American city, San Francisco, Chicago, New York, or even smaller regional hubs. What do you see? You see for lease signs. You see empty lobbies. You see the physical evidence of a permanent shift in how the world works. The work-from-home phenomenon was not temporary. It broke the model for office real estate, and valuations are collapsing. We have seen office towers that sold for $100 million in 2019 now trading hands for $30 million. That is a 70% wipeout of value. I want you to be my eyes and ears on the ground here. Pause for a moment and comment below. Are you seeing these for lease signs in your own town? Are the office parks in your area emptying out? Tell me what it looks like on Main Street, because often the national news hides the local reality. But here is the trap. The loans on these buildings have not been wiped out. The debt is still there. There is roughly $1.5 trillion in commercial real estate debt coming due for repayment or refinancing by the end of 2026. This is known as the maturity wall. When these loans were originated 5 or 7 years ago, interest rates were near zero. A building owner might have been paying 3% interest. The building was full, the rent checks were coming in, and the math worked. Today, that building is 40% empty, the rent roll has collapsed, and the loan is coming due. The owner must refinance. But they can't refinance at 3% anymore. They have to refinance at 7% or 8%. Do the math with me. You have a building generating less income, and you are asking it to service debt that costs twice as much. It is impossible. The math does not work. The owners will simply mail the keys back to the bank. They will default. And who holds these loans? This is the critical connection to the bond market. It isn't primarily the massive banks like JP Morgan. It is the regional and mid-sized banks, the very same banks that serve your local communities. These regional banks hold nearly 70% of all commercial real estate debt in the United States. When these loans default, these banks will face a solvency crisis. Their assets, the loans, will become worthless. To survive, they will need to raise cash immediately to pay depositors. And what is the only liquid asset they have left to sell? U.S. Treasury bonds. Goldman Sachs sees this chain reaction coming. They know that when the CRE defaults start hitting the headlines in earnest later this year, there will be a panic-driven fire sale of Treasury bonds by desperate regional banks trying to stay alive. This forced selling will crush bond prices even further. Goldman is selling their bonds now, quietly, at a small loss, to avoid selling them later, alongside hundreds of desperate regional banks at a catastrophic loss. This is the second shoe dropping. The first shoe was inflation raising rates. The second shoe is the credit collapse in real estate forcing a liquidation of the bond market. This creates a feedback loop from hell. Real estate crashes banks. Banks sell bonds, bond yields spike, high yields crush real estate further. It is a perfect storm, and the smart money has already put on their raincoats. But the real driver here is the macro trap, a mathematical dead end for the government. So, what is the iceberg? Why is U.S. debt, formerly the gold standard of safety, now being treated like radioactive waste? And to understand this, we have to look at the fiscal situation of the United States government. This is where the numbers become truly terrifying. As of early 2026, the United States national debt stands at $36.2 trillion. That number is so large it becomes abstract, but the cost of carrying that debt is very real. Because interest rates have risen, the government must pay significantly more to service that debt. In fiscal year 2024, interest payments on the national debt jumped to $879 billion. Projections for the current fiscal year place interest payments at over $1.1 trillion. And let that sink in. $1 trillion per year, just in interest. This is money that does not build a single bridge, does not educate a single child, does not pay for a single soldier, and does not provide health care to a single senior. It is simply the cost of renting the money we have already spent. To put $1 trillion in perspective, it is more than we spend on the entire military budget, excluding active war funding. It is more than the Medicaid budget. It is approaching the size of Social Security payments. Interest on the debt is rapidly becoming the single largest line item in the federal budget. Here is the trap. The United States government does not have a surplus. We run a deficit every single year. So how do we pay this $1 trillion interest bill? We borrow it. The Treasury issues more bonds to pay the interest on the old bonds. This increases the total debt load, which increases the interest bill for next year, which requires even more borrowing. This is the definition of a debt spiral. It is the financial equivalent of using a credit card to pay off another credit card, and then taking out a payday loan to pay the interest on the first two. Eventually, the math simply stops working. This reality forces us to confront a dangerous misconception, the Volcker fantasy. I know many of you remember the late 1970s and early 1980s. You remember the gas lines, the malaise, and the double-digit inflation. You also remember how it ended. Paul Volcker, the chairman of the Federal Reserve, stepped in and raised interest rates to 20%. It was painful. It caused a deep recession. Farmers lost land, businesses closed. But it broke the back of inflation and set the stage for the prosperity of the 80s and 90s. I want to pause here because I know many of you watching lived through this. You remember the 18% mortgages? You remember the CD rates? If you were there in 1980, leave a comment below. Share your story with us because the younger generation treats it like ancient history, but you and I know it was real. Today, you will often hear pundits say, if inflation comes back, the Fed will just do what Volcker did. Friends, I must tell you with absolute certainty, the Volcker option does not exist anymore. This is the critical difference that the talking heads ignore. In 1979, when Volcker started raising rates, the total United States national debt was roughly $845 billion. The debt to GDP ratio was around 32%. The country was, financially speaking, lean and solvent. We could afford to pay 20% interest on our credit card because the balance was small. Today, the debt is $36.2 trillion. The debt to GDP ratio is 124%. Do the math. If the Federal Reserve raised interest rates to 20% today to fight inflation, the interest payment on $36 trillion would be over $7 trillion per year. $7 trillion is larger than the entire federal budget. The United States government would be instantly insolvent. We would have to default on our debt or print money so aggressively that the dollar would collapse into hyperinflation. Goldman Sachs knows this. They know that the Federal Reserve is trapped. The Fed cannot raise rates high enough to kill inflation without bankrupting the Treasury. But they also cannot lower rates without letting inflation rage out of control. They are stuck in a box. And when a central bank is stuck, the currency and the bond market are usually the victims. Making matters worse is the supply and demand problem, which creates a doom loop. At the exact moment the U.S. needs to issue record amounts of debt to pay its bills, the traditional buyers are leaving the building. For decades, foreign nations, specifically China and Japan, bought U.S. debt voraciously. They exported goods to us, took our dollars, and recycled those dollars back into Treasury bonds. It was a symbiotic relationship. That relationship is over. China has reduced its Treasury holdings from over $1 trillion in 2013 to roughly $160 billion today, a 24% reduction. Japan is also selling to defend its own crumbling currency. The BRICS nations are actively building payment systems to bypass the dollar entirely. So, if the foreigners aren't buying and the big banks like Goldman Sachs and JP Morgan are selling, who is buying the debt? Increasingly, the buyer is the United States itself, domestic entities, and eventually the Federal Reserve. This creates a doom loop. The Treasury issues debt. The market refuses to buy it at current rates. Yields spike. To prevent a financial crash, the Federal Reserve prints money to buy the bonds. This money printing causes inflation. Inflation makes investors demand even higher yields to hold bonds. The Treasury issues more debt to pay the higher interest. The Fed prints more money. It is a vicious cycle that destroys the value of the currency. This is the mechanism by which empires fail financially. It happened to Rome. It happened to Bourbon France. It happened to Weimar Germany. It serves as the historical pattern, and we are currently tracing its outline. So let's walk through exactly what the unfolding collapse looks like. Goldman Sachs is preparing for a specific sequence of events. It is important that you understand this sequence so you can recognize the signposts as they appear. Stage 1 is where we are right now. This is the quiet exit. The smart money is distributing their holdings to the dumb money. Banks sell to pension funds, they sell to retail ETFs. They slowly lighten their load while telling the public that everything is fine. We are seeing volatility, but the system is holding together. Stage 2 is the confidence crack. This will be triggered by a specific event. It could be a failed Treasury auction, where the government tries to sell bonds and no one shows up. It could be a geopolitical shock. It could be another bank failure larger than Silicon Valley Bank. Whatever the trigger, the result is that bond prices slip aggressively and yields spike toward 5.5% or 6% on the 10-year Treasury. Stage 3 is the cascade. This is the point of no return. As bond prices fall, the banks that still hold them, the ones who didn't sell like Goldman, see their capital ratios obliterated. They receive margin calls. They are forced to sell assets into a falling market, driving prices down further. High-frequency trading algorithms kick in, exacerbating the sell-off. Panic spreads from the bond market to the stock market. Stage 4 is the Fed capitulation. Faced with a collapsing financial system, the Federal Reserve will be forced to abandon the fight against inflation. They will pivot. They will turn on the money printers to a degree that makes 2020 look like a warm-up. They will implement yield curve control, buying unlimited amounts of bonds to artificially pin interest rates down. This saves the government from nominal default, but it unleashes the true enemy, inflation. Not 3% inflation, but double-digit, structural inflation that persists for years. The dollar is sacrificed to save the bond market. I know that sounds abstract, so let's talk about what this means for you directly. I want to bring this right down to your kitchen table. I want to talk about what this means for your life, your home, and your legacy. If you are over 60, you are likely in the preservation phase of your life. You have worked decades to build your nest egg. You don't have 20 years to wait for a market recovery. First, let's talk about your home. Mortgage rates are mechanically tied to Treasury yields. If Treasury yields spike during a crisis of confidence, mortgage rates will follow. We could see mortgage rates hit 9%, 10%, or even 12%. At those rates, the housing market freezes deep. Young families cannot afford to buy your home when you decide to downsize. Inventory sits. Prices eventually must correct downward, perhaps significantly. The equity you view as your safety net could evaporate or become liquid. Second, and more dangerously, is your retirement account. For 40 years, the standard advice from financial planners has been the 60-40 portfolio, 60% stocks, 40% bonds. The theory was that bonds are safe. When stocks go down, bonds usually go up, providing a cushion. That correlation is broken. In a debt crisis, stocks and bonds fall together. Third is the cost of living. If the government chooses the inflation route, which history suggests is the most likely political choice, your fixed income buys less every month. Social Security adjustments rarely keep pace with real inflation, grocery and energy prices. You could find yourself in a position where your dollar balance stays the same, but your standard of living collapses. This is the inflation tax, and it falls hardest on retirees. This leads us to the most critical part of our discussion, a strategy for preservation. I am not telling you this to frighten you. Panic is not a strategy. I am telling you this so you can act while the exits are still open. Goldman Sachs has already moved. You still have time, but the window is closing. What can a prudent individual do in the face of $847 billion in institutional selling? First, you need to reevaluate your bond exposure. Look at your portfolio. If you are holding long-term bonds, 20 or 30-year maturities, or funds that own them, consider the risk. In a rising rate environment, the shorter the duration, the safer the capital. T-bills, treasuries that mature in less than a year, are far less volatile than long-term bonds. Money market funds currently pay decent yields with minimal duration risk. Follow the banks, they are shortening their duration. Second, realize that liquidity is the ultimate option. Cash gets a bad reputation because of inflation, and rightly so over the long term. But in the short term, during a liquidity crisis, cash is power. When markets crash, assets go on sale. If you are fully invested and everything drops, you are paralyzed. If you hold a strong cash reserve, 3 to 6 months of expenses, or a strategic percentage of your portfolio, you have the ability to weather the storm without being forced to sell assets at the bottom. Third, consider the historical safety of hard assets. History teaches us that when sovereign debt becomes shaky, capital flees to assets that are not someone else's liability. Gold and silver have been the primary beneficiaries of this flight for 5,000 years. They do not pay interest, but they cannot default. They are insurance against currency debasement. Real estate, specifically productive real estate or paid-off primary residences, also acts as a hard asset buffer, provided you are not overleveraged. Fourth, you must eliminate variable debt. If you have a home equity line of credit, HELOC, or any debt with a variable interest rate, pay it off or fix the rate immediately. In a credit crunch, variable rates can reset to punitive levels overnight. Do not allow your financial stability to be at the mercy of the Federal Reserve panic settings. And finally, avoid the get-rich-quick trap. In times of uncertainty, scammers proliferate. They will pitch you crypto schemes, penny stocks, or secret investments that promise 50% returns. Ignore them. The goal right now is not to double your money. The goal is to ensure your money survives the transition. Return of capital is more important than return on capital. Let's conclude by looking at the bigger picture of this wealth transfer. Friends, we are living through a pivot point in history. The economic rules that governed the last 40 years, falling interest rates, low inflation, and unquestioned U.S. debt dominance, are changing. Goldman Sachs did not sell $847 billion in bonds because they needed pocket change. They didn't do it on a whim. They did it because their models, their data, and their instincts told them that the risk of holding U.S. debt now outweighs the reward. They are voting with their wallets. They are betting that the future looks very different from the past. We often talk about wealth destruction during crises, but that is a misnomer. Wealth is rarely destroyed. It is transferred. It is transferred from the uniformed to the informed. It is transferred from those who hold on to the old paradigm to those who position themselves for the new one. It is transferred from the hands of those who react too late to the hands of those who prepared early. The warning shot has been fired. It was fired on a Friday afternoon, buried in legal paperwork. Totaling $847 billion, the smart money has made their move. They have headed for the exits while the band is still playing. The only question that remains is, will you stand there and wait for the music to stop, or will you follow the smart money out the door while you still can? One last thing before you go, this is a community of critical thinkers. I want to know your plan. Do you agree with Goldman's move to cash, or do you think they're being too pessimistic? Drop your thoughts below. I read every single one. Thank you for your time, your attention, and your commitment to your own financial future. Stay vigilant.